July 3rd, 2019. It's my birthday. I'm about to pick up this big, beautiful cake for the birthday party. And you know what? As I was doing this, I was like, hey, they're still preparing a few things here for me. I was like, let me record a few minutes on a subject that I've been meaning to record for you guys for a while. So grab a pen and paper, write this down, because this is incredibly important when you guys are trading options. And the typical question that I get, Leonardo, how do you get these 400-500% returns? I mean, we're trying to do it. We're not getting as much traction. So I'm going to give you a few tips. Okay. And the number one most crucial tip is not every market environment is suitable to produce this 400, 500, 600, sometimes 1,000% gains as we do with weekly options. Now, it is important to understand, however, the market environment that does create this sweet opportunity for you. And guys, right now, I'm like, you know, a kid in the candy store, because these option premiums right now that the market is charging us to participate in the market, they're insanely low. Now, let me explain this. When it is apparent, and I'm going to give you an explanation right now on both the bear side and the bull side. First, I want you to picture a market crash. And maybe you were expecting about the market crash last year when it was falling in November, December. And maybe you were saying, well, no, let me buy the dip because, man, all these valuations, they're so great. I can buy the dip. And, you know, as you were buying the dip, what was the market doing? It just kept dropping, dropping, and dropping. So you're like, man, let me buy some more. And it just kept dropping again. Well, for those bears that were buying the options on the bear side at the time, okay, they started doing it when it was apparent that the market was crashing. So they weren't buying the dip, but they were buying the put options. In other words, there were guys that went on the right side of the equation. But there is a huge difference in identifying that before it actually takes place and jumping in when it is already happening. And the main difference is the cost of options. The way you make money as a trader is, number one, there's a certain price that you will pay to the option. Number two is there's going to be a certain price that you will sell this option to. I know this sounds silly and elementary, but many traders really miss the understanding of identifying when the opportunity of what they're paying for the option and the opportunity of the magnitude of the move in relation to how much they can collect selling that option for within a certain amount of time. A lot of traders really lack the idea how to calculate it. So when the move is apparent to everybody, like again, the analogy when the market crashes, it is absolutely apparent to everybody that the market is crashing. So the demand for the put options is substantially higher. And what you end up paying is a much higher premium. When you're paying something higher, even when you're correct about the direction, okay, let's use Amazon as an analogy. When the markets were crashing, just to buy an Amazon put option, it would cost you $30, $40 or $3,000, $4,000 just to buy it close to the money, near the money. Okay? Right now, if you compare the market environment, the same options are priced ridiculously cheap on both the call side and the put side. But when you're paying something like $30, $40 an option, in order for you to realize a 300, 400, 500% gain, you would have to sell it for, you know, $120, $150. In other words, even with the crash, it's going to be very challenging to do. Even when the direction is clear, even when you know exactly what's going to happen, even when it's absolutely apparent to the market participants the market could be falling for another few days in a row. Because you're paying too much initially, it's going to be very challenging realizing these 300, 400, 500% gains. So the question is, well, how do you do it? Well, the idea is you have to understand the market environment when these option premiums are cheap. And so right now I've given you an example on the put side, but the same thing is applicable to the upside, right? Sometimes the market has its interesting way of miscalculating what these options should really be valued at. And right now we have such a sweet opportunity that everything is pointed out based on our market moves formula. We've actually, for the very first time, we've got not a 777, guys. We have a quadra 7 move where the markets have created, based on our 13 markets move formula, 4 days in a row created a move 7, which is incredibly bullish. So we are likely to continue setting all-time highs in the markets, and yet everything is pricing in the options premiums as there is going to be no substantial move. So when you see this sweet discrepancy in the marketplace, this is a time where you want to strike as a trader, because your cost of buying these options. And let me just give you a quick example. Yesterday, in our 13 market moves daily analysis, we were suggesting jumping in and buying some more Amazon calls. Well, Amazon calls on the dip when Amazon was trading about $1,910 yesterday on July 2nd. They were running about $4.50. This morning, even though it's a shortened session for trading, the market is about to close in the next couple of hours. It's about 11:50. Right before lunchtime as I'm recording this. Even on this shortened time frame session between yesterday and today, those Amazon call options have appreciated from $4 all the way to $16. Guys, that's an easy 4 times the money just from yesterday until today. And why? Typically, we would not have an opportunity to buy Amazon call options at such a significant discount. Sometimes we can't even buy them for $4 near the money like that on the last day of expiration, like a Friday. But right now, the market is giving us these crazy valuations on these options as if there is no upside to the market. But yet, as pointed out in the last video, we have coupled with the handles, we have institutional behavioral patterns that we pay very close attention to on a daily basis. We have our 13 markets move formula that screams that the market is about to break to all-time highs. We have the exact different sequence in our market move formula opposed to the 666 sequence that we have posted on this channel 8-9 months ago, which predicted the crash. Now we have exactly the opposite of that. That's being confirmed daily that the market is going to move higher. And yet these option premiums are ridiculously cheap. So guys, maybe your account is not at 100 grand yet. Maybe your account is not even at 25K yet. So if you're working with a small account, you want to acknowledge, number one, an opportunity when the stock market participants are completely mispricing these call options. And right now, this is such a case. So when you see the market is going to break above 3,000, which should happen very soon here. Hey, we may hit 3,000 by the end of today, July 3rd, or get pretty close to it. I wouldn't be surprised if we hit it on S&P right at 29.99 or something and finish the day there. But guys, with that said, these opportunities, okay, where it's not apparent to everybody that the market is going to break out higher, where most of the market's participants are still betting on the fact that the market is going to drop, okay, this creates an insane discrepancy, very sweet discrepancy for you to come in and strike and take advantage of such an opportunity. So just remember, it's going to be very difficult, especially if you got a smaller account for you during the periods when markets participants add an essential premium to these options. It's going to be very difficult to get some substantial traction. So you really got to scout and look out and calculate opportunities like this one in the market to where you can buy options premiums cheap in relation to the magnitude of the move. So once you figure out situations like that, and trust me, they're not going to happen daily. They're not even going to happen weekly. They may not happen for months at a time. So I wanted to bring this to your attention, guys, and let you know that it is right now one of these sweet discrepancies in options valuations that could help you propel your account to a substantially higher level. Now, to kind of draw a parallel between an example that maybe everybody could relate to, okay, I wanted to compare this to two buying behaviors that we typically see. One that makes a lot of sense, especially if like you're an accountant or a doctor, this should make a lot of sense, right? You want to buy low and sell high. If you're in real estate, you should understand this example very easily, right? You want to buy low and sell high. You want to buy a house at a lower price. You want to sell it at a later time at a higher price. You keep the difference, right? Now, the second strategy is what most of the people typically are doing, is FOMO, fear of missing out, chasing the market, chasing stuff, okay? And a good example would be when Bitcoin in December 2017 was reaching all-time highs, and we actually came out with our short theory and we said Bitcoin was going to drop to 3,500, Everybody was chasing it to the top after it had a substantial run. We've already seen the fear of missing out. In other words, we've put a video in November, December last year saying buy Bitcoin at 3,500, buy GBTC when it was $4. So now, most of the people that did not listen to the action that we recommended in those videos, they're buying Bitcoin now that it's over 10,000, now that it's over 11,000, now that it's, potentially breaking out to 13, 14,000. Now people are getting back in. The time to get back in the Bitcoin trade was in November, December last year. We posted a couple of videos. Congratulations to those of you that took action on these, because guys, these are easy 400-500% returns. All you have to do is be patient and stay with these trades. Now with that said, guys, the most important thing is this. You don't want to be using the second strategy when it comes to chasing, because when the market is going to break out to 3,000, 3,100, 3,200, 3,300, that's when a lot of people could actually get in, when it's actually going to be exactly the time to be getting out. So right now, based off the way the option premiums are priced in, majority of the market participants are not expecting a crazy breakout. And there will be an equivalent like buying Bitcoin for 3,500 bucks back in December, November 2018, as we recommended in our video. Now, most of the people are buying it now. In other words, what most of the people technically are doing, they're using the strategy of buying high in the expectation of selling even higher. See, right now, when it's going to become apparent to everyone that the market is going to all-time highs and it's actually going to be sustainable at least for a period of 30 to 60 days, everybody's going to be getting in, but they're not going to be getting in at the levels that we've been getting in over the course of the last week or two. Keep this in mind, that even though they look like they're the similar strategy, oh, what the hell, Leonardo, all you're doing is just buying calls. But they're truly different, because once it's clear to the market participants where the market is going, then these option premiums are going to skyrocket. And when these options premiums are skyrocketing, it's going to be very difficult to realize this 400-500% returns. So an easy way to look at it as this, okay? When market is mispricing the magnitude of the move, your premiums on either call options or put options is going to be mispriced. And this is the type of environment where you want to come in and you want to strike and you want to take advantage of this type of opportunities. Okay, so the easy way to think about it is, guys, how much you're paying for the option in relation to the magnitude of the move of this particular thing that you're looking to trade, whether it's Amazon, whether it's S&P, whether it's a biotechnology stock out there, whether it's a semiconductor stock, whatever it is that you're trading, always consider the magnitude and the time frame of that particular move. And look at the cost of the option that you're paying for it. So most of the time, the market is going to misprice these options. The market is going to expect a crazy move, and it's actually not going to materialize. Right now, we have exactly the opposite of that, where the market is mispricing the idea of these big magnitude in the move higher, and the options pricing are mispriced because of that. So if you have any questions, leave them in the comments below, guys. I hope this understanding of buying low, selling high in relation to how you would apply it in terms of options. Again, it all has to do with the market environment. If you're still unclear as far as how to decipher this, how to understand this, how to get better at identifying those great entry points that help you produce 400-500% returns, guys, I invite you to take the 13 Markets Move Formula course, because we spent a lot of time specifically going over the market environment and how to take advantage of it, how to take advantage of the market environment from the standpoint of where it makes the most sense to day trade it, from the standpoint of where it makes the most sense to swing trade it. Guys, if you understand the difference between when to day trade, when to swing trade, and when not to trade, and just observe, okay, you will ultimately propel yourself to a whole nother level of trading, and those are my wishes for you. I wish everybody happy 4th of July to you, your families, guys. I challenge you to take your accounts to all-time highs by the end of the year. Check the links below, and be the best trader you can be. Thanks for watching. I'll catch you guys on the next trade Friday.